Good morning. It's Tuesday, the 3rd of December, and this is Govindraj Ethiraj, headquartered and broadcasting as well as streaming from Mumbai, India's financial capital. The take, India's spiraling real estate market. Between January and May this year, real estate developer DLF sold about 3,000 luxury homes across multiple projects. On each occasion, these Gurgaon apartments adjacent to Delhi were sold in about 3 days' time. Most of these apartments sold for close to 7 crore rupees or almost $1 million each, at least at that time. Some 25% of these apartments were bought by non-resident Indians or NRIs, according to reports. This story is actually similar across India and has been in recent years. Premium properties have seen huge demand as well-to-do Indians, both resident in the country and outside, have snapped up real estate, bidding up prices project after subsequent project. While India's middle class tightens its belt, cutting back on everything from tea to two-wheelers, thanks to soaring consumer inflation, the richest 1% who own 40% of the country's wealth are snapping up homes in cities with well-paying jobs, says a Reuters poll. The poll adds that average home prices in India are set to rise now steadily over coming years, driven mainly by demand from wealthy individuals, while the rising cost of living will make owning a property unattainable for most people. Several research reports have already pointed out that the affordable end of the housing segment has been slowing quite sharply for the last year or more, with people at the lower end of the economic scale unable to afford houses or even put down that minimum, say, 10 to 20% required to apply for a loan. So could prices and demand be reaching peak levels now? The Reuters poll and report says that while demand is enough to sustain price rises in the short term, property analysts say there are limits to how much the rich can keep demand alive in an economy which is already slowing down. So much so that the real estate industry watchers are worried that the creamy end might slow down on buying, presumably because they might also get bored of buying property, at which point the market might fall suddenly. On the other hand, rents are thus expected to rise even faster than house prices by 7.5% to 10%, according to a range provided by about 11 property experts to Reuters. So, while it is good that premium segments of the housing market have grown rapidly and going by signs would continue to grow for some time, it's time to pay attention for those who are getting edged out of the housing market, whether for purchase or even rent. Cities like Bangalore have already seen discontent amongst its migrant youth after landlords started raising rents 2 years ago. Most of these youngsters work in IT companies or similar at starting or close to starting salaries, which have obviously not really risen. Combined with the general sense of insecurity in their own industries, rising home prices are a big deterrent to stability for the youth and thus a positive outlook for the future, which means they're not able to see a positive outlook for the future. A small digression, creating affordable home segments like the United Kingdom's social housing projects or Singapore's Housing Development Board, where homes are owned by the state or run by the state but rented out to those starting out, have never really taken off in India, where the need has been so high. And the lack of such housing projects has led, for example, to slums in Mumbai, where the onus of survival is placed on the individual rather than the state. High real estate prices also create other distortions, including in the channelization of savings, because people find it more and more attractive to invest in real estate or feel it's more secure than anywhere else. Now, this locks their capital in and locks out genuine buyers, as in those who would buy and stay in that house as opposed to investing in it. More significantly, high prices and frenzied buying also creates the impression that the economy is on a strong footing and triggers fresh construction of housing stock or more construction of housing stock. Now, if this sounds familiar, this is what helped create a 60 million backlog of unsold homes in China, as per a Bloomberg estimate 5 months ago. And that story has not ended well. And that brings us to the top stories of the day. The stock markets hold ground, gain in the first trading session of the month. The rupee hits another record low. What's going on? Oil rises on perception of a slow Chinese recovery. And another steel company gets into car making.
This is a core report with Govindraj Ethiraj.
The market surprise on Monday. The markets may have rejected the negative signals from India's poorer than expected GDP growth and Donald Trump's threat to slap 100% tariffs on countries like India or the BRICS countries, that's Brazil, Russia, India, China, and South Africa, who were thinking of an alternate currency. And instead, that is, the markets focused on the positive signals coming from Wall Street, which saw fresh records on Friday last week. Whatever the reason, the indices did end the first session of the last month of the year in positive territory. The Sensex was up about 445 points to close at 80,248, so it's still staying above 80,000. The NSE Nifty 50 was at 24,276. That's up about 144 points. The mid and small cap stocks also did well, and they did better than the benchmarks, with the Nifty Mid Cap 100 and the Nifty Small Cap indices all above 1% each. The rupee hits a fresh low. Where can it go? The Indian rupee declined to its weakest level on record on Monday at about 84 rupees 70 paise during the session, before ending at 84 rupees 69. The currency weakened about 0.2% on the day, its worst single-day fall since June 4th, the day India's general election results were announced. Reuters reported, adding that the rupee has hit a string of record lows over the past 2 months, as we've been reporting here as well. So the rupee, or rather its downward journey, is being driven by outflows, that's of dollars, with foreign portfolio investors selling, as well as a strong dollar that's got stronger after Donald Trump's re-election, and this obviously has affected other Asian currencies too. Interestingly, a report from Axis Bank says that while the rupee has become one of the most stable currencies globally over the past 12 months, it might be time for the Reserve Bank of India, whose actions have kept it so, to loosen up a little. The side effects of low volatility are now showing up, says that report, and a stable currency, while it signals macroeconomic health, some also see central banks incurring such costs like a public service, reducing uncertainty for businesses and investors. However, limited volatility over long periods of time has reduced corporate hedging, increasing the reliance on the Reserve Bank to suppress volatility. So the interesting point that's being made here, without getting into too much details, is that it appears, according to Axis Bank, prudent to shift some of that currency risk back to businesses and investors via a gradual rise in volatility, one that does not cause panic in unhedged parties or force intervention once again, says Axis Bank. Separately, to get a sense on where the rupee was headed and why there was so much weakness, I reached out to Kunal Sodhani, Vice President at the Korean Shinhan Bank, last night, and I began by asking him what explained that weakness right now.
I think it's important to understand the global trajectory because it's not about weakness in rupee. So as of now, we are aligning it to rupee. But if we talk about Asian currencies at large, they have all been weakening against the dollar. After the way the election results were with respect to the US presidential elections, and plus the behavior, historically, which we have seen of Donald Trump. One important thing why this is happening now and the trajectory is because of two reasons. One is about the propaganda which Donald Trump had during his election time. One was about the lower taxes, and second important one was about raising tariffs wherever required and wherever necessary to protect the US economy, employment at large. Both of these focus on one important thing is more government spending. And if there is more government spending, which will lead to further more inflation. And if further more inflation comes into picture, the rate cut trajectory may take a back seat. It may not be that aggressive. So this trajectory, what I explained, is leading to a rally in dollar across all currency pairs, starting with majors, emerging markets, and Asian currencies. So this is the backdrop as we are discussing.
So this is the external part. And what are the internal factors?
So internal factors, there are a couple of things which one needs to observe. One, the most important factor is flows. When we talk about dollar rupee pair, I think flows are the major drivers. So by flows, I mean the domestic equity flows. If we talk about the month of November, we saw an outflow of almost around 94,000 crores. Even if we talk about the month of December till date, we have already seen an outflow to the tune of around 21,000 crores. Plus, considering December end where book closing happens for the foreign companies as well as the offshore countries, the anticipation of flows being negative still holds true. So historically, again, we see so flows remain an important factor which is not in the favor. Second, also, if we talk about the fiscal deficit number, where the fiscal deficit number till October, which was announced yesterday, came at around 46.5%. Vis-a-vis the same number was at 45% the same period last year. So that is still remaining a concern. And one of the most awaited data was the GDP data, which obviously came far off than the expected number to around 5.4%. I think lowest since last 7 quarters to be right, is again affecting a mindset of how RBI will behave from now on, because it's about two things. One, when the GDP is getting affected by so much, there are one set of people who think that rate cut now is imminent and is a must. But on the second side, if I talk about the elevated inflation and still the global uncertainties prevailing already because of the Ukraine and Russia plus the Middle East, and now Trump coming into picture and inflation further can rise up, is creating some kind of mindset that this rate cut trajectory will move from even RBI, where they may pause rate for this coming policy also. So, lastly, one more domestic factor which I want to highlight is whenever we are seeing this depreciation, also, we have also seen how RBI has behaved. And even if it is a reflection from the FX reserves data now, which is standing around $658 billion. So I think it is also clearly indicating that, somewhere, obviously there is FCA, which is foreign currency assets, which are getting revalued. But at the same time, sharp intervention has also been seen by RBI in order to curb some kind of volatility.
You're saying that the forex reserves are down, which they are, and you're saying the fact that they're lower itself is a signal.
So the fact they are lower itself is a signal of couple of things. One, obviously, maybe RBI is also seeing some kind of uncertainties and they want to hold. But at the same time, historically, again, we have seen that RBI does leave certain levels. It's not like, for example, when we were at around 84 levels, I think it for a couple of months it took and it broke that level and we found a new high. Similarly, even now, what my personal observance is when Asian currencies start depreciating, like for example, Chinese yuan or South Korean won, like South Korean won is above 1400 now, or even Chinese yuan around 7.28. When they start depreciating, RBI tends to be less aggressive or tends to sideline themselves. They may not be that aggressive, which is again a reflection to me, and thus we saw levels of 84.70 also today. So I think RBI also behaves in a manner that they don't want to lose that export competitiveness against these Asian countries or currencies. At the same time, they don't want any kind of excessive volatility as well.
So, if you were to look in the near future, I think the distant future might be too distant, but in the near future, what are the cues that could help you determine which way things will go? And what are you looking out for?
Once the Trump comes in and how the tweets play around, we have seen predicting anything is almost impossible. Let's be honest about it. But yes, if I talk about rupee, it's not that predictable. But if we talk about dollar index at large, because it is more matured, dollar rupee still has this illiquidity into picture. So considering dollar index, there is still scope of one more move towards 108 plus levels. We have seen those levels tested and sharply moved even below 106 recently, maybe yesterday or day before yesterday. But I think this might not stall. So my anticipation is dollar index may strengthen a bit from here, testing once again that 108 half 109 levels once again. The all-time highs recently, or we have seen, is around 114. Obviously, that's too far off. I'm not talking about that story, but I think this appreciation of dollar will continue. Also, one more reason I want to state here is the recent comment by Donald Trump on the BRICS, where it was clearly stated that in case if you're looking forward for your own currency or trying to ignore dollar, 100% of tariffs could be imposed. That was one of the major trigger points of weakening of rupee and the Asian currencies, apart from the domestic factors, which obviously we have stated. Now, this talks about the internationalization of other currencies or the replacement of dollar or dollar de-dollarization is the right term, I would say. So somewhere my personal take is China has been trying this since past 11 years. And obviously BRICS now has been discussing it more aggressively. A lot of other members have also joined BRICS. If you talk about Egypt and many other countries or UAE, and 34 countries are in queue who wants to join BRICS. So I think the threat remains that if more than 50 countries are eyeing something else, the dollar gets threatening. So if we also historically speak, starting from Bretton Woods system, dollar was a flip flop, then went to, if we talk about the Nixon effect, which happened in 1970s, there again they were dealing to the dollar. So somewhere this currency and oil have been the major players to look out. And if such kind of things happen, I think de-dollarization may take a lot of time from here on. For me, I think the movement is more towards a multi-currency system rather than a replacement of one currency by another. So I don't think the replacement can happen because 90% of the global reserves and trade are in dollars. 64% of the global debt is in dollar. So it is not that overnight or maybe in couple of years things can just fade away or be replaced. But I think the focus will remain on multi-currency systems, local currency invoicing, and slowly, steadily the share going lower. That's what my personal take is.
Right, Kunal, thank you so much for joining me.
My pleasure. Thank you.
Oil prices trend up. Oil prices have risen somewhat, interestingly following signals of some recovery in China's economy. Brent futures traded at above $72 a barrel, and they had fallen about 3% last week after China's factory activity had then showed tentative signs of recovery. China is also the world's biggest crude importer. Meanwhile, OPEC, or the Organization of Petroleum Exporting Countries, has pushed back its meeting on supply by 4 days, which was supposed to be on December 5th, according to Bloomberg. OPEC is widely expected to delay a slight increase of production for a third time. So very broadly, oil has been trading in a range of less than $6 a barrel since mid-October, driven by, of course, a varied set of reasons, from geopolitical tensions affecting both demand and supply potentially. The government scraps a windfall tax. The government in India has scrapped a windfall tax on crude products, aviation turbine fuel, ATF that is, and petrol and diesel exports, according to a government statement on Monday reported by Reuters. The tax was first imposed in July 22 on domestic crude oil production that was introduced after a rise in global crude prices to capture revenue from windfall gains made by producers here. This also applied to some products refined from crude, including aviation fuel, petrol, and diesel exports. So the government collected about 13,000 crore rupees through that windfall tax last financial year, compared to about 25,000 crore rupees the year before that, according to government sources quoted by Reuters. And this year, the government has collected about 6,000 crores, though the government does not release a breakdown of windfall tax collections. New entrants in electric cars. Perhaps for the first time in decades, companies from diverse backgrounds are jumping into the mobility business, and more specifically electric cars. While electric two-wheelers have already seen myriad newcomers, including startups, launch their products alongside the traditional brands like Hero, Bajaj and TVS, the four-wheeler segment has not really seen any Indian entity or new Indian entity announce significant plans. Now that is changing, with steel giant JSW Group saying it wants to launch an electric vehicle under its own brand. The Business Standard quoted the Financial Times saying, technically, Tata Motors' predecessor was also a steel company, being Tata Steel, and they all were once housed in Jamshedpur, though that was, of course, in 1945. And Tata Motors, then known as Telco or Tata Engineering and Locomotive Company, started by making locomotives. The first heavy commercial truck from Telco, now Tata Motors, came in 1954, and the first car came in 1998. Back to JSW, in an interview, Chairman Sajjan Jindal said JSW wanted to establish itself as a key player in India's growing EV industry. And JSW also had announced a $1.5 billion joint venture with SAIC Motor, the Chinese company that owns the MG brand, which you can see on Indian roads, to produce and sell MG EVs in India. So JSW's new EV facility is going to come up in Maharashtra's Aurangabad area, which is also, like I said, its in-house brand. And JSW is apparently going to invest about 27,000 crores and create about 5,200 jobs and manufacture both passenger and commercial electric vehicles, according to that report. So, while battery-powered two-wheelers have gained immense popularity in India, adoption of four-wheelers has slowed, at least behind hybrids, at least for now. Electric vehicles currently account for about 2% of passenger car sales in India, translating to around 100,000 units annually. That was the Core Report with me, Govindraj Ethiraj. Do stay connected with more of our coverage at the Core. You can check out our website or sign up to our newsletter for our exclusive stories, one in-depth feature a day on www.thecore.in. Do also track us on LinkedIn, where we usually post synopses or extracts of our top stories and interviews. We would love your feedback on how we can make business more interesting and relevant, including, of course, India's vibrant manufacturing sector. So write to us at feedback@thecore.in, and thank you once again for listening.